Hi, I'm Felicia. I'm a CPA financial planner, and today we're going to talk about reviewing a tax return. I've prepared and reviewed thousands of tax returns so far in my career, and I know how tax can feel daunting, maybe like a mystery. And so today we're just going to go through and review a tax return so that you can have a little bit more power up your sleeve. And this video today is going to be geared towards W-2 employees. If you guys like this video today, we'll jump into what to look for when you're self-employed or maybe have your own business. Starting with the first part of your 1040. The IRS has hundreds of tax forms that point to and from each other. So think of the 1040 as the summary page of what happened with your income expenses for the prior year. You'll see up at the top your name, your address, social security number, all of the details that identify you as a taxpayer, and also it will include your dependents. This is a very important part to review, especially if you had children in the past year or have children that have grown into doing their own taxes so that you don't claim somebody that you are not eligible to be claiming for this year. If you're paying somebody to prepare your taxes for you, this is actually a very important piece for you to be looking at. Towards like the middle top of this form, you'll see filing status, and make sure that who you're claiming is accurate. Now getting into the fun part of the 1040, your income. If you're a W-2 employee, meaning you're receiving equal paychecks throughout the year that are having taxes withheld on it from your employer, you will see what your total income was in line 1A. And you'll see right on this form that this should equal the total amount from your form W-2 box 1. So if you want to check and make sure that what's reported here on line 1A agrees exactly to your W-2, easy review, you can do that. The rest of the lines here under line 1 may not be applicable to you if you're receiving most of your income as a W-2 employee. But the next line that I'd like to see for my clients that I'm preparing taxes for is something in line 2. Line 2A is for tax-exempt interest, think your municipal bonds, which we won't get into today, and taxable interest, so from a high-yield savings account. If I'm preparing somebody's taxes for the first time and I don't see anything within this line, I will talk to them about what their emergency fund is being saved in. Or if they don't have an emergency fund, we can start talking there too. You can be receiving more interest than your typical bank is giving you. So look into a high-yield savings account if you haven't already for your savings. And then at tax time, you'll receive what's called a 1099 INT, short for interest, that you will then report on your tax return to include that taxable interest. The next line item on your 1040 is going to be for your dividends. So if you're a W-2 employee who's taking some of your income that you're earning during the year and investing it in a taxable brokerage account, you'll see taxable dividends here. Line 3A is for qualified dividends and 3B is for ordinary or non-qualified dividends. If you have a taxable brokerage, you'll receive what's called a 1099 div, short for dividend, or a 1099 consolidated, which will show all of your gains, losses, and activity for your investments. And that gets reported here. The rest of the line items you may not see anything on if you're in your income earning years and a W-2 worker, but something that's popular among W-2 workers is the backdoor Roth IRA. And if you participate in a backdoor Roth IRA, you should be seeing something on IRA distributions, but nothing in the taxable amount if you did this correctly. The next line item that you might be seeing a number in on your 1040 is for capital gains, line 7. Again, this comes from your taxable brokerage account if you sold any shares during the year, and it gets reported here, as well as pointing to Schedule D if you're required to break it down. And then guess what? We come to your total income. Review this number, make sure it seems reasonable for what you expected to come from last year. And if it seems short or if it seems like too much, make sure you bring that up with your CPA or you're going back to what you input into your tax software. The next line item you want to take a look at is line 10. Line 10, if there's anything here, will point back to Schedule 1. And it's Schedule 1, page 2, because the first part of Schedule 1 is any additional income that needed to be broken down. Typical adjustments that you might be seeing as a W-2 employee could be contributions to your IRA that are deductible, HSA contributions that were not deducted already on your W-2, and if you're a qualified teacher, up to $300 for expenses that you paid. Yes, $300 is not a lot. And then once you take all of your adjustments against your total income, you come to what we call adjusted gross income. Adjusted gross income is important because it's used to calculate if you qualify for other deductions or credits that come later on your tax return. And then the next line item is line 12 for your standard or itemized deductions. Everybody starts with a standard deduction based on their filing status. And from there, you decide if itemized is better if it's greater than the standard deduction. Typical itemized deductions include state and local taxes, like your income taxes and property taxes, interest that you pay on your primary home, that is up to $750,000 of your mortgage if you're after 2017, and medical expenses if they're greater than 7.5% of your adjusted gross income. Remember that number we talked about a little bit earlier. And charitable contributions. All of those are typical itemized deductions that you would take instead of the standard deduction if it's better for you. So if you claim itemized deductions on your tax return, make sure you're reviewing Schedule A to make sure that everything is appropriately classified and included there. The next important item on your 1040 is your taxable income. You might be seeing a little bit under your qualified business income deduction, depending on what your investments are that we talked about earlier, which is going to help also decrease your taxable income. In the United States, we are on a marginal tax system. So as you earn more income, that income gets bumped into higher tax rates. It doesn't mean that all of your income is subject to that higher tax rate, but that income associated with that bucket is taxed at that tax rate. So let's say for 2024, you're a single taxpayer that brought in $100,000 of income. You find that the standard deduction is best for you because you don't have as many itemized deductions, and so you take off the first $14,600 of your $100,000 of income. After that, up to $11,600 is going to be taxed at 10%. Then the next $35,549 is going to be taxed at 12%, and your remainder income is taxed at 22%. And that's how your tax is going to be calculated outside of capital gains rates. If you had long-term capital gains income, meaning that you had some qualified dividends or you had long-term sales of shares that you held for more than a year, then you would be subject to the long-term capital gains tax rates on that income as well, which ranges from 0 to 20%. If you have children that you claim on your taxes, you should see something on line 19, child tax credit or credit for other dependents from Schedule 8812. And if you have any other credits that you're taking against your tax, you will see that on Schedule 3. Other credits that you might qualify and see on your tax return are dependent care credits, solar credits for installing any qualified solar on your home, and foreign tax credits if you have any foreign investments that you've already paid taxes on and you get a credit on that on your US taxes. After all that, you come to what your total taxes on line 20. This line then gets netted against what you've paid in taxes during the year. If you're a W-2 worker, you've probably had taxes withheld on your pay stub, which you will see here on line 25. If you made any other tax payments during the year or qualify for any of the credits that you'll see listed below, those will also be shown in this section. And then you come down to if you have a refund or if you owe, you'll see that amount here too. Hopefully you don't see any amount in that little penalties box, but if you do, this is actually a great opportunity for planning for next year's taxes. The IRS likes to get paid as you do. So that means they want you to pay your taxes as you're receiving your income, or else they're going to charge you with an underpayment penalty if you're filing your taxes on time. Sometimes other penalties can be involved if you're filing your taxes after the April 15th deadline. So be sure to file an extension by April 15th and pay your taxes up front on April 15th if you think you will owe anything, so that you're not accruing any interest or late payment penalties on that amount that you might owe. If you're receiving a refund, I understand that feels really good because at least you don't have the stress of having to get together some cash to pay the IRS. But pay attention to how much this refund is, because it could be money that you could do something else with during the year, like invest it and make more money on it. But the other side is underpaying your taxes. If you're a W-2 employee and most of your income is just coming from your employer, you want to review your W-4 for withholding if you have a big discrepancy here and you owe a lot of money. But the other part that some W-2 employees experience when it comes to under withholding of taxes is they might have RSUs or other stock compensation that they're receiving from their employer, and they might not have enough tax withheld there. So you want to review when you receive those payments, and if tax is being withheld. Well, that brings us to the end of this video, and if you made it this far, I really greatly appreciate you sticking around. If you have any questions, please feel free to leave them below in the comments. And if you liked this video, I'd love to hear that from you as well. If you didn't like it, that's okay too. We're human, we don't have to like everything that everybody else puts out here, and that's the joy of YouTube. Either way, I hope that this video helped you a little bit when it comes to reviewing your taxes, and I'll see you on the next one.